All right, so the next thing we're going to talk about is the auditor's report. We will talk about this a lot more in a lot more detail when we get to audit. But first of all, let's just kind of talk about an audit. When we're talking about an audit in this realm, we are talking about a financial statement audit, not an IRS audit. There's lots of different kinds of audits, but we're talking about a financial statement audit. Okay. In the financial statements audit, it is also audited is the internal controls. Okay. It's an attest function and it tests the fairness of the financial statements. We want to know, are they following the rules of GAAP? Okay. There's four basic types of auditor's report. The most common is an unqualified opinion. Unqualified is a clean opinion. It says there is a high likelihood that there is no material misstatements. Okay. And why is this more common? Because even if the auditors find a material misstatement or they find something wrong, usually the company will fix it. Okay. Because they don't want to have one of these different types of opinions. They want to get the unqualified report. Okay. There could be unqualified with an explanatory or emphasis paragraph. It could be qualified or it could be adverse or a disclaimer at the worst. Okay. I've kind of already said all this. Okay. So I said unqualified is a clean opinion. Most audits end up being unqualified. Okay. Let's talk about the professional care is going to include sufficient planning, understanding of the company's internal controls, and the auditor is going to gather evidence to attest to the accuracy of the amounts reported in the financial statements. Okay. So some of the things that could give us an unqualified with an explanatory paragraph could be lack of consistency, going concern. Going concern means you don't foresee this business, you see this business going bankrupt maybe within the coming year. Or there is a material misstatement that they didn't fix. Okay. If they fixed it, it's probably not even a concern. Okay. So this may be unqualified with an explanatory paragraph. Okay. Others could be nonconformity with GAAP, inadequate disclosures, a limitation or restriction on the scope of the audit examination. As an auditor, when you go into a business to audit their financial statements, there's really nothing that they could hold from you. Like if they say there's this closet over there and they said you can go in any closet, any room in this building except for that one. What's that going to make us think? We're skeptical accountants. We're going to think then, what are you hiding in that closet? Okay. They should be able to talk to any employee of the company because they're gathering evidence. Okay. So there may be a limitation in the scope of the audit examination. Okay. In these situations, it could be qualified adverse or disclaimer. Okay, I'm going to skip over that. Okay, so using financial information, so investors and others will use this information. They're most interested in the outlook for the future of this company. Investors are interested in any kind of default risk. What does that mean? Not being able to pay your obligations, pay your debts as they come due. And then operational risk, which relates to how a company can withstand various events and circumstances that may impair their ability to earn profits. Okay. So we also have financial statement analysis, and we've done this a couple of times. I know all of y'all are in financial management right now, so we have talked about this in that class as well as principles of accounting too. We can look at comparative financial statements, looking at 1, 2, 3 years. We can do a horizontal analysis or we can do a vertical analysis, and then we have all those ratio analysis that we could do. Okay. Our liquidity ratios, okay? Liquidity, we're looking at the current ratio and we're looking at the acid test ratio, or called the quick ratio, okay? Do they give us those? Yes, they do. So current ratio is just current assets divided by current liabilities. And so in this one, they calculated the current ratio of 2.72. That is pretty good. Okay. That is really, really good for a company like Nike. Wouldn't think it's too high, but it is a really good number. Okay. Working capital, if if you get a negative number here, that means your current liabilities are more than your current assets. That's not a good thing. So a positive working capital is always a good thing. Okay. When we do the acid test ratio, we're taking out inventories, prepaid items, and some restricted cash. We take those out. What the quick ratio says is if every single one of our current liabilities came due today, could we pay them? Most of the time, this ratio is not going to be over one because we're not usually not going to be paying all of our debts. Think about all your bills that you have to do within the coming year. What if you had to pay them all today? We'd all be bankrupt. Okay. None of us would be able to have enough cash or quick assets that would cover that. It's just another measure of liquidity. So if this number drops below one, it's probably okay. Okay. We would compare that, and this looks very comparable to the current ratio being really good and solid, and the acid test ratio also being really good. But again, don't panic if a company has this as less than zero. Okay. So they're looking at industry averages. How do we compare to the industry averages? So let's just look at current ratio. Current ratio for the industry is 174. We're higher than that, so that's good. Acid test ratio, look, I told you, don't panic if it's less than one because most of the time it will be. But we are also doing better than the industry average when it comes to the acid test ratio. Okay. Solvency ratios, these are looking more at the long-term debts. Okay. Some common ones, debt to equity ratio and times interest earn ratio. Okay. So our debt to equity ratio is our total liabilities divided by our shareholders' equity. Okay. So here, our debt to equity ratio is 1.68. Um, Industry average is 1.01, and then we are 1.68. Okay. Times interest earned. This is a really, really important one because this kind of shows you how not all debt is bad. Okay. So if you can borrow money and then turn that money and generate it five, six, seven, 8 different times, then it was worth it for you to borrow that money and spend that interest expense. Okay. So come down here, times interest earned is really high, 22.31. So they earned all their interest back 22, over 22 times. Okay. So it's well worth that interest that we paid to be able to make that larger profit. Okay. Relationship between risk and profitability. Usually, when things are risky, there is the chance for a higher return. Okay. More debt can mean a higher return on the shareholders' equity. Okay. We actually did a problem in financial management showing how issuing debt actually made earnings per share go up rather than issuing stock. Okay. And here's that thing called financial leverage. This is almost identical to the problem we did in financial management. And it kind of shows the return on equity for both of these alternatives. Okay. I'm going to not spend just a lot of time on that because we have spent some time on that in financial management. All right. I will see y'all in the next video.